The CME just went completely dark. And what happened next changes everything you know about gold. For 37 minutes, the world's biggest metals exchange vanished. When it came back, gold prices showed a $283 gap that shouldn't exist. I spent weeks tracking down the data they tried to bury. And what I found will shock you. But first, hit subscribe if you want the truth about your money. Let's expose this together. The CME system went offline without warning. 37 minutes of silence. When trading resumed, gold prices showed a $283 difference between paper contracts and physical delivery costs. This spread doesn't happen in healthy markets. Think of it like this. You order a product online for $100, but when you try to actually receive it, they charge you $383. That gap tells you something is broken in the supply chain. In 2020, during COVID panic, we saw similar spreads, but that was a global emergency. Today, there's no official crisis, yet the pricing gap appeared anyway. The CME blamed technical issues but offered no details about what failed or why. Historical data shows these spreads only emerge when physical metal becomes scarce while paper promises keep multiplying. In 1980, the Hunt Brothers silver crisis showed the same pattern. The question nobody's answering: if there's enough gold, why does it cost $283 more to actually take delivery? The numbers don't add up. For every ounce of physical gold in CME vaults, roughly 100 paper contracts claim ownership of that same ounce. These contracts are promises to deliver metal, traded like the metal itself. Here's the problem. When everyone believes they own gold through paper, the system works. But when people start asking for actual delivery, the illusion collapses. It's like a bank that loans out the same dollar to 100 customers, hoping they never all withdraw at once. Current vault data shows CME gold inventories at 23 million ounces. Yet open interest in futures contracts represents over 2 billion ounces of claims. That's a 100-to-1 ratio. In 1971, this exact pattern forced President Nixon to close the gold window when foreign nations demanded physical delivery for their dollars. The system couldn't deliver what it promised. Today's $283 spread signals the same stress. Physical buyers are paying massive premiums because paper sellers can't easily access real metal. The question remains, how long before someone demands delivery the system cannot fulfill? Central banks are quietly moving their gold home. Germany, Netherlands, Poland, Hungary, all have pulled physical metal from London and New York vaults in recent years. They're not selling, they're relocating. This pattern reveals deep distrust. If these vaults were safe and reliable, why spend millions shipping gold across oceans? It's like removing your money from a bank before anyone announces a problem. In 2013, Germany requested its gold back from the Federal Reserve. They were told it would take 7 years to return. 7 years for metal that supposedly sat in allocated storage. That delay raised uncomfortable questions about whether the gold was actually there. Today, central bank gold buying has reached record highs. China and Russia lead this accumulation, adding hundreds of tons yearly. Meanwhile, Western institutions keep promoting paper gold products to retail investors. The entities that built this system are exiting it. What do they know that the public doesn't? The gold highway between London and New York is breaking down. These two cities have controlled global gold pricing for decades. Metal flows between them based on where prices are higher. But lately, the pipeline is clogged. Delivery delays have stretched from days to weeks. Shipping costs have tripled. Refineries are backlogged with orders to recast London bars into New York acceptable formats. It's like a traffic jam where everyone suddenly needs the same exit. In March 2020, this exact bottleneck caused temporary market chaos. Traders assumed it was pandemic-related. But the same stress has returned without any health emergency to blame. COMEX warehouses report eligible gold, metal available but not registered for delivery. This category has grown suspiciously large. Eligible gold sits in vaults but isn't promised to anyone specific. Why isn't it being registered? The physical infrastructure is straining while paper trading volumes keep climbing. Something has to give. When systems fail, someone always profits. The CME outage didn't hurt everyone equally. Large institutional traders with backup data feeds continued operating while retail investors sat frozen. Timing matters in markets. 37 minutes is an eternity. Major banks hold enormous short positions in gold futures. These bets profit when gold prices fall. But here's the anomaly. These same banks are simultaneously accumulating physical gold for their own vaults. They're betting against gold on paper while hoarding it in reality. It's like a casino owner telling customers the game is risky while secretly playing at his own tables. In 2010, leaked documents revealed banks had manipulated LIBOR rates for years. The same institutions now dominate precious metals, trading desks. Regulators fine them billions for past gold manipulation. Yet their market dominance continues unchanged. Who had advanced knowledge of the outage? Trading records exist. The question is whether anyone will investigate them. History doesn't repeat exactly, but patterns echo. 3 precious metals. Crises share DNA with today's anomalies. 1968, the London gold pool collapsed when Western nations couldn't suppress prices anymore. They had sold too much paper gold while physical demand overwhelmed supply. The $35 peg shattered. 1980, silver spiked to $50 when the Hunt brothers demanded physical delivery. Exchanges suddenly changed rules mid-game, allowing only selling, not buying. The insiders protected themselves. 2020, COVID triggered a $70 gold spread as physical delivery became impossible. Markets blamed the pandemic, but the weakness existed before the virus. Each crisis followed the same sequence. Paper promises multiply, physical demand rises, spreads widen, then the system breaks. It's like stretching a rubber band. Slow tension, then sudden snap. Today's $283 spread exceeds all previous warning signals. Central banks are hoarding. Delivery is failing. Institutions are betting both sides. Every historical ingredient is present. The pattern suggests we're not approaching the crisis, we're inside it. The $283 spread is a countdown clock. Markets can ignore reality temporarily, but physics always wins. Paper gold can't substitute for physical metal forever. The evidence points toward a moment when someone large demands delivery the system cannot provide. Maybe a sovereign nation, maybe a billionaire fund. The trigger doesn't matter. What matters is the domino effect afterward. When delivery fails publicly, confidence evaporates instantly. Paper contracts become worthless promises. Physical holders name their price. It's musical chairs with real consequences. Smart money is already positioning. Vault audits are being refused. Delivery clauses are changing overnight. Insurance companies are limiting coverage on precious metal storage. These are evacuation signals from institutions that never panic publicly. The window for exchanging paper for physical is narrowing, not because of conspiracy, but because of math. You can't deliver 100 ounces from a vault containing one. The greatest wealth transfer in history happens when paper promises meet physical reality. The CME outage wasn't random. The $283 spread wasn't temporary. These are structural cracks in a system stretched beyond its limits. Every pattern we've tracked, the paper multiplication, the vault exodus, the delivery failures, the institutional positioning, they're all converging toward the same outcome. The precious metals market is splitting into 2 realities: paper prices that institutions control and physical prices that scarcity determines. History shows these divergences end violently, not in years, but in days. The London gold pool operated normally until Friday, March 14, 1968. By Monday, it was dead. Today's evidence suggests we're in that Friday moment. The institutions know it. Central banks know it. The spread knows it. The only question is whether individual investors will recognize the pattern before Monday arrives. When paper gold dies, physical gold doesn't disappear. It simply reveals its true price.